I'm Warwick Sabin, Executive Director of the Society of Fellows, and it is my pleasure to welcome all of you to this SOF digital discussion. I hope you and your loved ones are healthy and safe, and I want to thank you for being part of the Society of Fellows. Your membership directly supports and sustains the work of the Aspen Institute, and that support and work is more critical now than ever before. We introduced this new digital platform to keep our community together during this challenging time, and we've had a great response so far. If this is your first digital event with us, here are a few technical details. There will be an opportunity to answer your questions after Nancy makes her initial presentation, and you can submit your questions anytime by simply clicking the Q&A button at the bottom of your screen and typing them in. And if you encounter any problems during the event, please email the SOF hotline and our team will be glad to assist you. We are very pleased to have Nancy Lazar as our speaker today. She is Global Chief Economist and co-founder of Cornerstone Macro, and before founding Cornerstone, she was co-founder and vice chairman of ISI Group for more than 20 years. Nancy has been an institutional investor-ranked economist for the past 17 years, ranking in the top 2 the past 9 years, and in 2015, she ranked number 1. In 2020, Nancy was included as one of Barron's 100 most influential women in US finance. Today, she will share her insights on the recent market volatility, the impact of the unprecedented stimulus, and the longer-term economic outlook. And I'd also like to point out that Nancy is a member of the Society of Fellows, and we're glad to have her here with us today. Nancy, the floor is yours.
But let me jump right in. So it is definitely a unique global economic backdrop in many ways, but we are seeing positive policy responses with awe-inspiring global stimulus. So that's the focus of the discussion today. Let me start out on page 2, and I'm going to quickly go through some of the big 3 themes we have going through this current crisis, potentially what healing process will look like here in the back half of 2020, hopefully, and then what are some longer term potential changes, which we're calling global behavioral changes that could indeed impact global economic activity for years to come. So this is just a quick review of some of the other previous crises that have indeed hit the US economy. And as we all know, this is very unique and very difficult as an economist, quite frankly, to actually forecast. But we're indeed giving it a try. We have some basic things that we are focusing on. First and foremost, we are focusing on the unfortunate events that are going on around the world. We were one of the later countries to be negatively impacted by the COVID crisis. And so that actually gives us a little bit of a way to learn from others' mistakes or what other countries are indeed seeing from a progression standpoint. And some of the countries that have been hit first, particularly obviously China, but also Taiwan, you have seen an incremental improvement in their economic conditions, in part because you have seen a slight shift down in the number of daily cases. Here, I'm measuring the number of daily cases. And so then the question is, how sustainable is this shift down? Well, if you look at the Singapore chart over on the far right, what you see is that Singapore got a little lax in maintaining their lockdown. And as a result, you did have a sharp spike in the number of cases of Singapore. What's the importance of this? And you also saw a similar trend in Japan, which I don't have here. But what we're learning is that you can't open up your economy too quickly because you are at risk of seeing another spike in the number of cases, which both Singapore and Japan have, and maybe even China, because China is now starting to unlock their economy also. So there's a lot of talk as far as what will it look like once we come out of this this crisis, and odds are it will be much more of a U-shaped recovery rather than a sharp V from a GDP perspective. It's also encouraging. Europe also got hit very hard in the first quarter, not just in the second quarter. It's also encouraging that you are seeing the number of new cases in Italy and Germany also shift down, and even here in the United States. I'm in New York right now, and to be sure, we have lockdown in New York City, and it is indeed good that we're helping to contribute to a slight shift down in the number of new cases. But some of the other states, we're also watching individual states that have done a better job locking down and trying to control the cases, in particular Ohio and Washington. Much smaller numbers than what we're seeing here in New York. Obviously, they're smaller states, but also their stability, slight improvement is encouraging, as is the case in California. So New York was a little late in taking the crisis seriously, but we're now making some good progress. Still devastating. The number of deaths in New York today, I believe, hit a new high. So we still have a road to recovery, but we're making progress. Obviously, the lockdown is affecting global economic activity, is also affecting the credit markets. The credit markets are potentially an added risk to the negative impact from the crisis that we're seeing today. Why? Well, obviously, credit is one way you fund a lot of business activity. It's how you fund the housing market. So along with the onset of the crisis, along with the lockdown, pretty quickly, we had a severe hit to global credit markets from the high grade market in the middle of the page to obviously the lower grade market, and also globally, even outside of the United States, you've seen the credit markets seize up pretty quickly. That's something policymakers can impact quicker than they certainly can with the COVID crisis. And so indeed, you've had the Federal Reserve step up very, very quickly. Unfortunately, we've had some experience before with the credit markets back in 2008, 2009. The Fed was a little late in responding, to the extent it was a new problem we had in 08, 09. Whereas today, they have a kind of a checklist of what they need to do when they run into a credit crisis. And very, very quickly, the Federal Reserve has added over $1 trillion, almost $1.5 trillion to the financial markets in just 3 weeks. So you are seeing a very, very quick response. I'm going to go back. And as a result, you've seen some healing already in the credit markets, which is indeed a very, very good sign. Now, the Federal Reserve has actually also announced some new programs to support the credit markets. And that is particularly useful for the corporate bond market. The Fed in the last crisis did buy mortgage-backed securities. For the first time ever, the Fed is now buying, will eventually be buying corporate bonds. They have not yet started that program. My colleague, Roberto Perli, expects them to step up and buy corporate bonds as we move through April. The program is new and is taking some time, unfortunately, to set up. But nonetheless, the improvement we've seen even before the Fed has started to buy corporates is very encouraging, helping to heal business confidence. Again, this will not be a cure-all, but it's important the credit markets don't seize up, because that would just make the economic backdrop even worse. Another support for the economy, which is very different than what we saw during the last crisis, is the health of the U.S. banking system. You've seen very quickly bank loans. This is very timely data through March 25th. You've seen very quickly, these are C&I loans, commercial and industrial loans for businesses, increase very dramatically in just 3 weeks. In contrast, as we moved through the financial crisis in 2008-9, bank loans actually started to decline as the banking system shrank significantly. And so again, this just highlights the importance of, one, having a very proactive Federal Reserve, and two, have a healthy banking system where, to be sure, funds can get to the economy sooner rather than later. It's not perfect, to be sure. Under the fiscal stimulus measures, there is a small business lending program that's just getting started. Unfortunately, there were some delays in that. But again, the banking system is working, and that should help. So as I mentioned, the subtitle of the report is Awe-Inspiring Stimulus. And here's just a very, very quick snapshot of what we've been seeing from countries around the world. The United States has led the world as far as being very, very quick in implementing stimulus, understanding that the stimulus isn't all being used immediately, but it will be over time an important backstop to increase the odds. As we see an easing of the COVID cases, we can start to see an incremental improvement in economic activity. So let me go through some of these numbers, just really what's going on in the US very quickly. So as I mentioned, the Federal Reserve has very quickly increased liquidity into the system, about 1.5 trillion so far. By the end of the year, you're likely to see a minimum of a cumulative 2.5 trillion, a minimum of 2.5 trillion. That's about 12% of US GDP in and of itself. Now, there's actually a lot of room with that 2.5. The Fed could actually expand their balance sheet even more. And a lot of those policies that the Fed is putting in place can be levered up. And so again, that number is a minimum. If you look at the fiscal side, this includes the CARE Act, plus some other smaller programs that had already been put in place. That's also about 12% of GDP. So as you'll see as I go through this, we have US GDP growth declining about 25% in the second quarter, and we're getting about stimulus right now to the tune of 24%. I have to stress, we're not done. And in fact, Washington right now is working on a phase 4 stimulus bill. We don't yet know what that's going to look like. Additional support for small businesses, additional support for individuals will certainly be a part of that package. But the point is, this is a record amount of stimulus that we've seen for a record hit to US economic activity, obviously, except for the Great Depression. Other countries are also stepping up. Japan just a week ago had stimulus, total stimulus to the tune of only 6% of GDP. This week, they've already put in additional stimulus to the tune of 23%. So we expect other countries to follow what the US has indeed done. It's important to remember also that going into the crisis, we were already in a global easing cycle, and you were already starting to see that help boost economic activity. There is a view that policy doesn't work. Well, in this particular case, there will be a long lag between the impact of policy on economic activity, but lower interest rates, economic stimulus do work historically. And at the end of the day, that's why it's important for policymakers to implement. We are also seeing lower interest rates around the world, liquidity, fiscal policy, and lower interest rates. We've counted 114 cuts over the past year, with 47 of those cuts happening since January 16th alone. Policy is incredibly proactive and increases the odds growth won't be as bad as it otherwise would have been. So how bad will growth be? As I mentioned, we have US GDP growth. Economists look at things quarter to quarter, not year over year, and then we annualize them. That's the way the GDP data are always reported. And in the second quarter, we're expecting, after a lot of analysis and detail, a 25% decline in US GDP growth. And that is the biggest decline quarter to quarter on record. During the Depression, we did decline 25%, but that was for entire years. We don't have that kind of decline going forward. It's very difficult to forecast, as I mentioned, but in watching what we're seeing in other countries, we think the rate of decline in the third quarter will likely be significantly less than in the second quarter, but a decline nonetheless, and hopefully by the fourth quarter. But I would say I have very little confidence in that number right now. Again, a lot of that will depend on what we're seeing from a virus perspective. And so this is a devastating hit. This is why we're not the only ones. Obviously, the community has recognized a severe hit to overall economic activity. Vehicle production, for example, is going to, you're reading anecdotes that the auto industry is shutting down. Some of them are obviously making healthcare equipment right now, but on balance, overall auto production is shutting down, closing factories. Even in the month of March, vehicle sales dropped sharply. And as we go through April, they're going to be cut even further, cut by half again. And so this is obviously going to impact overall economic activity, as will the drop in jobs. Companies are, to be sure, laying off people. We saw that in the surge in unemployment claims last week. And going through the data, there's a chance we could see payroll employment, that number we get every Friday, first Friday of the month, for the month of April alone, could drop 20 million, taking the level of payroll employment basically back to where you were in 2011. And that would give you an unemployment rate surge of 17%, which would be the highest unemployment rate, again, since the 1930s, since the late 1930s. The difference is, again, in the 30s, these numbers were egregiously bad for almost an entire decade. And that hopefully is not going to be the case, to be sure, today. Small businesses in particular are getting hit very, very hard. There are ways we can monitor that. Indeed, small business hours worked, because these stores, these businesses are literally being shutting down, are declining 60%. Those are devastating hits, and you're seeing similar declines in employment. in those industries. So what can we watch to gauge what's going on today? We happen to have a daily consumer confidence index, and I'll tell you, over the years as we've had this, I often question, why do I have a daily survey of consumer confidence? Isn't that a little extreme in trying to understand what's going on? The answer is yes, it's very extreme. But right now, thank goodness we do this daily survey, because it, quite frankly, has helped us a lot gauge of where we are today. There's a lot of important information. We're talking to not we, I have a professional polling company do this, but in the survey, we're talking to 500 people every day, answering these 5 questions on the top right-hand side. And you can see the consumers are saying this is a very egregious backdrop. The reason this will be important is it will give us some of the first hints to one, how policy is potentially impacting the consumer, how maybe some healing in the stock market is impacting the consumer, how maybe the job market is stabilizing. Those things as of now aren't helping. But as we go through the spring and in the summer months, we think this will be very, very useful. The consumer is getting hit also very hard, harder than overall GDP. We're using down 30%. I'm going to go through some of this minutia quickly. Within the consumer spending, we know there are some signs, some areas where spending obviously is going to increase significantly on the right-hand side, from grocery stores to healthcare, but at the same time, other areas that are getting hit hard. And we're coming up with these estimates based on anecdotes we're hearing from companies and other weekly data that we can monitor. Again, let's not forget we've all gotten very good at e-commerce, and this is probably going to be a secular shift up in the amount of shopping, not only shopping but banking that's done on e-commerce. And so our purchases of tech equipment could very well also stay relatively robust. But you're going to see a huge bifurcation, obviously, in the consumer spending numbers as we get the data. Travel, I mean, I'm in New York. I'm not in Aspen. I wish I were. I can't get there. Indeed, you're seeing gut-wrenching declines in the travel industry with hotel revenue down 80%, airline activity down 90%. These are numbers I never would have expected to have seen. In addition, even though interest rates are low, to be sure, people are backing off of large expenditures, including housing. And this is something we're going to have to watch as we go through the years. I'm looking for also potential risks, which is, could you see potential mortgage problems as a result of obviously people losing their jobs, seeing a sharp declines in their income. So again, we're not out of the woods. Housing could indeed be negative. The outlook outside of the United States is even worse than particularly in Europe. Than inside of the United States. I mentioned earlier that the United States has a healthy banking system. That's not the case in Europe. I mentioned the United States had been pretty proactive, moving very quickly. That's not the case in Europe. The United States going into this crisis was actually pretty healthy. That's not the case in Europe. So Europe is going down even harder than we were, and their policymakers are moving slower than we are. So why this is important is, one, a lot of our companies do business in Europe. And two, I'm nervous when you get such a shock to economic activity, you can get secondary shocks that can also come back and have make matters worse. So I'm watching Europe very, very closely with the declines in GDP, not only in 2Q, but also in 1Q in Europe. Italy is such a sad, very, very sad state right now. They were one of the weak links in Europe to begin with. I'm seeing numbers out of Italy I would have expected to have seen in a modern age, where their GDP could actually decline 30% in aggregate in the second quarter. And even the strongman of Germany, they didn't move quick enough. That economy is also moving very severely into a recession. In addition, the emerging economies are very fragile. We have some emerging economies that are too dependent on dollar funding, have too much dollar-denominated debt, too dependent on China, too dependent on global trade. So what I've just done is I've moved from the United States. I got it, pretty gut-wrenching hit. Let's look at the foreign backdrop. A lot of our companies are tied to the foreign backdrop. Pretty devastating hit. I.e., what are some of the risks that could come back and impact the United States along with domestic problems? The international backdrop is also simultaneously a potential risk there. And again, these are just some of the countries that we are particularly worried about. Now, the Fed has put in place a program to try to curb the dollar, but the demand for dollars is so strong. And obviously, the United States at the end of the day is probably one of the safe havens around the world. And so the demand for dollars is strong. And that's a risk to some of these very, very fragile emerging economies right now. Now let's switch gears, and now let's look at what path China actually went through, and what we can learn from China, as to the extent they obviously were at the forefront of the crisis. What are we seeing there today? What policy responses have they put in place? And is the economy incrementally starting to improve as a potential timeline for what we could see in other parts of the world, including the United States? So this chart deck, just this page just highlights the devastating hit to China. Again, nothing which they've ever seen the likes of, from overall economic activity down dramatically year on year, an incredible plunge in car sales, to their GDP potentially almost being cut in half in the first quarter. The question is, will they actually report these kinds of numbers? But our analysis suggests that that's indeed what happened to China in the first quarter. To be sure, China similarly has moved very, very quickly, very, very aggressively, and to the extent to which the economy is still fragile, they are continuing to ease. We've saw even more easing just this morning out of Beijing, to try to support economic activity. They actually laid the foundation for what policy should be. They did rate cuts, fiscal stimulus, and also liquidity supports. And now that's what you're seeing in other parts of the world. And a little encouraging that you're starting to see green shoots. As I mentioned earlier, green shoots are somewhat better economic activity. You have seen an incremental shift down in the number of cases, new cases in China. They have started to open up the economy a little bit. There is a lot of stimulus, and you are seeing some of the data start to turn. Now, some of these look very robust. The turn in what we call the PMI, which is a survey of business activity, has increased very sharply. No, what that really means is you've stopped deteriorating. The index has gone from 38% to 51. 51 is basically stable growth. And so, no, this really just suggests China is stabilizing, which is good news, because the question is, when will we be able to also stabilize? So China can stabilize after putting in place a significant lockdown, supportive policy, and slowly opening up the economy. They did it relatively quickly. I'm not sure the United States is going to happen, and it's not going to happen as quickly as the United States as it has in China, but it's encouraging that it has indeed happened. Let me now shift gears a little bit. And there is concern by maybe some of you, and certainly if you look at the price of gold, that we are setting the stage for an inflationary backdrop. No, indeed, we think we're preventing deflation right now, and I can address that more with any questions that you might have. But when you have a collapse in nominal GDP to the tune of potentially 20-25%, that will be a massive hit to pricing power. And you're certainly hearing anecdotes already about massive deflation, not inflation. So now I do not think anytime soon we're going to have an inflationary problem. Given the uniqueness of this crisis, what I find I have to do historically is keep perspective, stay focused. What do I need to watch to gauge what's happening on a daily basis? And so we have what we call the 5 C's: confidence, credit, claims, COVID, and China. And so every day we're monitoring these, and to be sure, lots of other things. But again, to try to keep perspective and a focus. So as I mentioned earlier, our consumer confidence survey is still deteriorating significantly. Unemployment claims, the job market is obviously still deteriorating. The numbers this week could be even bigger than what we saw last week. But at the same time, you are getting early signs of an incremental improvement with the credit markets improving, number of COVID cases in the United States and around the world starting to fade, and potentially some currency stability. So our 5 C's right now don't look as bad as they did. And that is because of a policy response on the monetary and fiscal side, and also success on the lockdown starting to hold down the number of new COVID cases. I'm going to touch on a longer term. If you remember that third bullet I had at the very, very beginning, this is not just obviously a devastating hit to global economic activity right now. There will be behavioral changes as a result of this unique phenomena, such as savings rates around the world from the United States, China to Europe will shift up again. That doesn't mean consumer spending can't grow. It's just that it won't be as rapidly as it otherwise would be. Is that bad or good? As an economist, I would argue that's a healthier perspective. On the other hand, it will be bad to the retail community, for example, who got used to the consumer spending very heavily. So that will be a long-term headwind to small and large businesses if the saving rate shifts up. Notice that it did already shift up in the last expansion. For similar reasons, we obviously had an unusual shock the last recession. And so indeed, there is a behavioral change on the part of the consumers. There will also, second, be a behavioral change on the part of businesses. Sorry, offshoring to China is done. This is actually a topic that I've been focused on for about a decade. We've called it the manufacturing renaissance starting back in 2010. Pretty difficult to talk about in the early stages, but with the trade war, corporate tax cut, and now COVID, the massive offshoring we've seen from the United States is done. That is net positive for the United States. It is a net negative for the EM world. It changes the financial markets dramatically. It'll be more important for companies to be focused on investing in the United States than in China. Third, will companies continue to borrow, quite frankly, irresponsibly? We think this is, again, an important lesson of excessive credit is not a healthy place to be. The consumers this time actually had a pretty good balance sheet going into the crisis. Unfortunately, many companies, not all, a lot of healthy companies out there, but many companies are way over levered and they're paying the price right now. And we think as we come out of this, we will see similar behavioral change on the part of the consumer, where you can see corporate debt not be as egregious. There are other longer term secular changes which we see. Again, we can come back to that. I just want to spend one more minute on this new phase of globalization, as we're calling it. And it's globalization is not dead. I've studied globalization for 30 years, as many economists have, because it became very apparent in the 1990s that this indeed was the path to growth, shifting investment from the DM world, from the larger economies, older economies, to the emerging economies, to the EM world. And indeed, we saw it in spades. I would argue, and I have argued, that that has not been a positive trend for US economic activity. Potentially positive for many companies who are able to lower their costs, maybe positive for some consumers who bought increasingly more product from the EM world, but net, no, it was not good for US economic activity. We think that era is done for these three reasons. China's cost advantage has evaporated. Tech innovation has made it more efficient to actually invest in the United States. And then you add the corporate tax cut. Indeed, that makes it even more efficient to add to the United States. And then you add to body blows, so to speak, which is the trade war and tariffs disrupting the supply chain, and to be sure, COVID doing the same thing. Who in the world decided to put all of our pharmaceutical production, not all, but a good chunk, in China, not only in the United States, but around the world? A single source for a supply chain has proven to be very difficult, and that's now perfectly clear, along with these other two forces, causing a shift in globalization, not just from not with investment just going to the EM world, but coming back home to the DM world. You can see the boom in China's investment cycle back in 2000 when they joined WTO, 2001 when they joined WTO, and the corresponding surge in US imports. We've already started to plateau our global imports and incrementally shift down, in part because of the trade war. And we think that trend, though, will indeed continue. There's a view, again, that this globalization backdrop was great for the world. It was great for China. It was great for individual companies. It was not great for the US economy. And there's no easier way to show that than to look at the US stock market relative to world stock markets. We underperformed during that global boom. And as that global boom, actually, as that globalization boom started to fade, 2010, 11, and 12, then our market started to outperform because we created a healthier economic backdrop. Again, I can go into that in more detail. There could incrementally be some other smaller pack rim countries that could benefit, to be sure, and those are potentially interesting places to invest. You've already seen some of that, but that's missing the bigger theme. We're now in a new stage of globalization where more and more investment is coming back to the end user of the product, including the United States. And these next few charts I'm going to go through quickly. I've spent too much time on this topic. You can see the structural changes that are unfolding. This last chart on page 38 to me is just very crucial. We had a healthy job market the last cycle. I'm not suggesting everyone was better off, but boy, we were a lot better off than we were in 2002 through 2008. During that particular period, we stopped investing. We destroyed the breadth of the labor market, Labor force participation rate declined, and we had a very quick spike in wage inflation, inflation in general. We were not healthy 2002, 2008. It wasn't just the mortgage debt problem. It was that we stopped investing and put everything over there. Oh, the last expansion, 2010 through 2019, you saw that change. That investment cycle, as China unwound their excess investment, started to come back to the United States, created a healthier job market, lured people back in the labor market, net supporting moderate but sustainable wage inflation. So at the end of the day, I think you have to take a look at this new stage of globalization. The last one was negative for the United States. As we saw the last expansion with the acceleration in GDP, incremental GDP growth and potential GDP growth, this one is positive. And you see it around the country, you see it in individual markets. I'm going to go through these things quickly. The world has changed. The coasts are not necessarily where the strength is going to be. Middle America is our favorite emerging market. And it's not just going to be driven by building factories, it's going to be driven by the finance community, hospitals investing in technology, retail investing in technology. And so a new economy investment cycle is going to be particularly robust, as it was the last expansion. So at the end of the day, the conclusion is, we believe there is a major change in globalization. The United States incrementally is one of the healthier developed economies in the world, acknowledging absolutely some of the extreme headwinds we're currently facing, but looking out to 2001 and beyond, and EM growth, which already slowed the last expansion, actually converges down to US economic growth rate of about 2 to 3%. So I'm going to stop where I started with these key themes again. Maybe they make a little bit more sense now that we've run through things. The world's changing significantly, and it's not clear we're going to be the same when we come out of it. There are some positives, along with, to be sure, negatives. But the bottom line from an investment perspective is to acknowledge the change, because there will be too many companies, too many countries that are still focusing on what was and not will be. But thank you, Warwick, very much. I perhaps went a little bit over time. I apologize, but there are certainly a lot of things going on. So let me stop here and see what questions you all might have. Thank you.
Thank you, Nancy. No, it's a terrific presentation, and we're perfectly on time, and we do have several questions. I do want to remind everybody who's still participating that if you'd like to submit a question, there's a Q&A button right at the bottom of the screen. You just click that, type your question in, and submit it, and we'll try to get to it. So Nancy, in the interest of time, I'm going to kind of read each question one by one, and maybe we can efficiently get through them. I'll start with Mark Taba, who asks, Fed action helps in improving the liquidity of bond and credit markets, but 2008 was a liquidity event, whereas today we're talking about a solvency problem and a drying up of corporate cash flow at historic rates. He asks, how do we cope with this new element?
So to the extent, you're absolutely right, that what the Fed is doing is specifically targeting the credit markets. It could have been worse. It could have been not just a corporate solvency issue. It could have been a credit crisis a la 2008-9 and a solvency issue. So the Fed made it perfectly clear they knew exactly what they were doing, in that they were supporting the credit markets to prevent a credit crisis. On the solvency side, that's up to the fiscal authorities. Again, China has made it perfectly clear that it is fiscal, and now we are embracing that. It is the fiscal side of the equation. And what China has done, and I've learned a lot in watching what China's policies have been tax relief, fee relief, regulatory relief. Even China has eased up on regulatory. And so that is income, to be sure, income relief. We suspect that's exactly the path we've started on, and that will indeed continue. We're not done.
Terrific. The next question we have is from Laurel Cato, and she was asking, at what point does the Fed run out of ammunition to stimulate with phase 4 program or beyond, given that the overall national debt is at about $24 trillion? She asks, at what point does further stimulation become inflationary?
So here in the United States, again, there are the two supports for the economy. There's the Fed and the fiscal. We would argue on the fiscal side and on the monetary side, when you have such destruction in income, there's more ammo than we would otherwise think. The Fed, my colleague Roberto, who used to work at the Fed, highlights it's not clear if there is a cap on how big the Fed's balance sheet indeed could be. In Japan, I believe the central bank balance sheet might be actually equal to GDP. I'd have to go back and check. I think it's roughly equal to GDP. So right now the Fed's balance sheet is that would be a horrible thing to have to go through. But the point is the Fed does not have necessarily can't run out of bullets. When it comes to the fiscal side, there certainly could be the federal deficit this year, 15, 20% of GDP, who knows, egregiously large numbers. The worst thing for the policymakers to do is to do what happened in the 1930s. They initially were restrictive in the 1930s. The Fed was. And then they tightened too quickly in 1937. So when you have these gut-wrenching collapses in income, no, you're not creating inflation. You are preventing massive deflation. But I must admit, this, to be sure, is new, and I'm not sure we actually know the long-run implications of all the policy that are currently being put in place.
Thank you. The next question is from David Knockomson, who asks, the stimulus package is significant, but if people cannot go back to work, isn't the impact of the stimulus reduced?
Absolutely. I mean, the multiplier of the stimulus today is not one for one. No question about it. Some people, quite frankly, probably need the income and will spend all of it on necessities. But the income that people don't need to spend, they're not going to. They're going to save it. So no, the multiplier of fiscal stimulus during a recession is never one for one. To be sure, as much of it that can be saved is saved. But the good news is, again, it's a buffer. It's not a cure-all. It's a buffer, and policymakers are indeed talking about continuing to increase it. So no. I mean, GDP. We have GDP down 25% in the second quarter, with the stimulus now starting to flow into the system. It's a buffer. It would be worse without it. I'm not sure how worse it would be. I can't fathom that, but it definitely would be worse.
Okay. The next question is from Charlotte Siegel, who asks, you mentioned the U.S. banking industry remains strong, but what are the risks to the U.S. banking industry stemming from this crisis?
Yeah, so there seems to be a lot more coordination. I mean, I can't believe I'm saying this. Thank God for the last crisis. We learned a lot on the importance of supporting the banking system quickly. And so right now, the federal government is asking the banking system to make a lot of small business loans, and they are certainly going to be risky loans. The Federal Reserve actually hasn't yet, but will be implementing a program where they actually will be potentially buying some of those loans from the banking system to get them off the bank's balance sheet. So not that there won't be mistakes. There certainly could be, and there certainly could be risks, but the Federal Reserve is very well aware of those risks, as is Treasury, and they're working to actually minimize them. Yeah.
Okay. And then Todd Martin asks, what is your outlook for U.S. equity valuations going forward?
So within the market, there will be probably huge bifurcations, simply because there will be winners, such as the technology space, and then there will be losers, such as many within the leisure space. So averages in today's economic environment are almost meaningless, and it's almost important to go in and look at individual companies that have a real shot of flourishing in the next expansion, and I think there will be an expansion, and so averages are very difficult to guess. It's being a stock picker, which I am not, but in talking with my colleagues and many investors, that increasingly is going to be important going through this massive transition.
Excellent. This question is from Peter Rigby, who asks, how would you contrast the U.S. approach to writing checks to individuals versus the European-German approach to stimulus, which is to keep the companies up and solvent and keeping employees on the payroll?
It's an intriguing concept. Germany in particular did it the last expansion. Short term, it does mitigate the severity of the crisis. It supports confidence more than it otherwise would. It's quite frankly a kind of a little counter to my schooling. But in an environment like today, it seems to be a more humane way to go. This administration in Washington, they kind of regret plowing a lot of money through the unemployment programs. Unfortunately, things have gotten clogged up in the states, and they're talking increasingly, if they do send out additional, it will be more direct from the federal government to the consumers. So unfortunately, we can't backtrack on this. What's done is done. I'm not convinced what Europe has done long term is healthy for businesses, but to be sure, in a crisis, it's certainly more humane.
Okay, and then Todd Benson asks, knowing that few are paying rent in April, what happens to the CMBS market? What are the implications, and how can this be resolved?
Yeah, and so that's also it's you know so sad what's happening here in New York City. There is going to be some flexibility amongst many of these commercial real estate companies, understanding the flexibility that they need to be flexible with the companies that they just don't have the revenue to pay. The government is also working on that space, but again, it highlights so importantly on maintaining healthy balance sheets, even during good times. That goes back to that corporate debt chart I showed you earlier, that as the consumers learned the last expansion, and hope to God, quite frankly, companies have learned it today, taking on a lot of egregious leverage is a bad idea, not a good idea. And unfortunately, many of those companies are potentially going to suffer.
Indeed. Not sure if you can answer this question, but Alex Kasdan asks, if social distancing works and strong economic growth depends on interaction, how do we get back to a full functioning economy, I assume, without herd immunity or a vaccine?
Yeah, so that last bit is certainly very important. If that could come about quickly, that would certainly make our lives a lot easier. But that goes back to comments many people have been making today, and I would certainly agree with it. It'll be a long time before we go back to normal. Disneyland, airplanes, restaurants. You want to make sure there's distance in all of them. And here, living here in New York City, there's nothing better than going to some of these bustling restaurants, heck, even in Aspen. But it's going to be a long time before we do that. And so absolutely, this is a behavioral change in many ways. And businesses are unfortunately going to need to adjust.
Excellent. And then there have been several questions of people who loved your presentation, wondering if it will be possible to share the PDF of the deck that you used.
Sure. Please do.
Okay, we'll make sure.
Just let us know how to do that. Absolutely. And if anyone has any other questions, please let us know.
Absolutely. No, we'll be glad to facilitate the distribution of that. Just a couple more questions too. I know we're technically over time, but I think those of you who asked the questions probably don't mind hanging out to hear the answers. One question, and this is from an anonymous attendee. You are forecasting a reemergence of domestic manufacturing, but do we have the trained workforce to accommodate the expansion?
I'm sorry, can you ask that question one more time?
Sure. The question was, you were forecasting an expansion of domestic manufacturing. Yeah. But this person wants to know if we have the trained workforce to accommodate that.
Well, that was the blunt answer is we will. What was so exciting the last expansion is the business community was embracing training people from ex-cons. I've actually spent a lot of time analyzing the prior ease of hiring a lot of people who unfortunately were in prison. They were getting jobs, to people undereducated. And that's what's so positive about a long expansion, that businesses become more willing to train people. And that was happening in the back 2015 through 2019. It was very exciting what you were seeing. Unfortunately, this is a big setback. It could be years before we are again able to embrace that kind of breadth in the job market. But absolutely, we saw the training the last expansion. We can do it. We'll do it again. I visited a prison, saw inmates learn coding to operate machines in factories, computers in factories. And these fellows were getting out of jail and getting jobs, and good paying jobs. So absolutely, I have all confidence we can retrain our workforce. Excellent.
What do you think about the dollar's role as the global reserve currency? Do you think that will change?
Nope. It's bad here, guys, but boy, it's pretty unfortunate what's going on in many other parts of the world. Europe, they don't have fiscal unity in Europe, and it's being very difficult to put in place fiscal policy in Europe to help some of those countries that are really, really struggling. We can do things pretty quickly. And again, I worry about the emerging economies, including China. China's done growing, 6 to 8%. Their growth trajectory is 2 to 3%. Therefore, they're not going to be the sport to the EM world that they had been. So as of now, certainly things can change. The United States is unfortunately the best bunch in a pretty bad global eco environment.
Okay, and we have time for one more question. I'm going to go back to Charlotte Siegel, who submitted another question. She asked, what are the factors underlying your thesis that Middle America is the next emerging market?
Well, that's another hour presentation. But I had some of the slides in the handout we just reviewed. China is no longer competitive. We've cut our corporate tax rate. Technology now makes it possible to manufacture in the United States. And we've all seen how important it is to get the supply chain back to where the products are actually used, because when you disrupt the supply chain, you have an even bigger economic hit, as we're seeing right now, even in something like pharmaceuticals. So I've actually spent a decade on this theme. I think this latest event with the COVID crisis is a nail in the coffin on the popularity of offshoring and now onshoring. And Middle America is a very reasonable place to live. From a cost perspective, a lot of great schools, a lot of business-friendly states, and in turn, economic growth is going to move from the coasts. I'm not going to move. I'm going to stay here in New York, but economic growth is going to move from the coast to the middle part of the country. I'm from Michigan originally. I'm not going to move back to Michigan, but indeed, my niece and nephew will probably stay in the Midwest. So,
excellent. Nancy, this has been a terrific presentation. I think it was obviously...
I got it up and running. Sorry about that.
No worries. We got a slow start, but we took the extra 5 or 6 minutes to make sure we got to everything. And really, it was so comprehensive, obviously very timely. I think everyone appreciated it. Obviously, everyone was very engaged with all the questions that they had to ask, and we had a great crowd. So I want to remind everybody who participated that we're going to be doing these digital discussions weekly. And pretty much we'll be doing that until we know we can come back together again in person. And so I hope you'll keep an eye out for our schedule. Of course, we'll be emailing you weekly to let you know who's coming. Next week, our event will be with Lori Gottlieb. She's a psychotherapist, writer for The Atlantic. She's been with us before. She'll be talking about embracing vulnerability in times of crisis. So I think it'll be a terrific event, April 17th. And then April 22nd, the week after that, we'll be featuring Kyle Drop, another SOF member, who will be talking about his work in polling, and he'll be talking about measuring public opinion amid this pandemic. So a lot of great content coming up. We'll keep you posted on all of our speakers. And again, thank you for participating today. We look forward to seeing you at our next SOF digital discussion.